You want to know what are the best stocks to buy now? I've got 3 stocks that I think are attractive right here. Let's go. If you've been following Fired Up Wealth for a while, you know that we are bullish and have been for years on semiconductors, the new oil. All the disruptive technology, the secular growth trends that we talk about, autonomous vehicles, robotics, cybersecurity, data centers, all of it. It can't happen without semiconductors. Now, one very important part in the process involves semiconductor production and the machines needed to create semiconductors. So, of course, the obvious semiconductor names are going to be the NVIDIAs, the AMDs. These are fabulous semiconductor companies. In other words, they're not actually creating the chips, and they rely on companies like Taiwan Semiconductor. That's going to be a foundry. Now, these foundries rely on equipment manufacturers like Lam Research, Applied Materials, KLA, Tokyo Electron, and what's the other one that I didn't mention? Well, the other big name, which is very important for one specific step, a very critical step, lithography, the company ASML. ASML machines generate extreme ultraviolet light. They do this by hitting a molten tin droplet 50,000 times per second twice. And this is done with a laser beam. Now, it's actually mind-boggling if you think about the technology behind this. Later, we're going to talk about competition, but the barriers of entry just to come up with the idea of this and have the engineering capabilities to make it happen, well, it's nothing short of outstanding. In fact, the plasma that these machines generate is hotter than the surface of the sun. So that's 9,930 degrees Fahrenheit and 5,500 degrees Celsius.
That's hot.
Damn right it is, Paris. Now, of course, chips keep getting smaller and smaller and faster and faster. And ASML is critical in order to make that happen. The structures on these chips are just a few nanometers in size. And we've talked about this before, but one human hair, just one hair on your head, is 90,000 nanometers. Just think about that for a second. We're getting these structures down to just a couple of nanometers, and one human hair is 90,000 nanometers. Why is the stock down and what price should you buy? We're going to get to that. So here's what's going on. I'm going to simplify this the best I can, do it concisely as possible. ASML, so early earnings publication. This was a human mistake. The combination with this and guidance has made the stock drop significantly, especially from recent highs. In fact, trading today at $689, it is now down about 4% year to date. It is still up about 13% over the past year, and it is up about 170% over the past 5 years. Now, with that said, the 52-week high, the all-time high, was $1,110 not that long ago. Now, this part is really important, and it impacts not just ASML, but many other names in the semiconductor space. They gave us a glimpse into China and how these export curbs will dent China's sales, not only for ASML, but other names, especially in the equipment space. So earnings actually beat expectations, 7.5 billion euros. So you probably wonder, why is the stock down? Net bookings came in at 2.6 billion euros, that's $2.83 billion US dollars, and well below the 5.6 billion euro consensus estimate from LSEG. So the stock was down 16% on Tuesday, another 5% today. This is the worst sell-off that we've seen in ASML in 20 years. The stock shed over $50 billion in market cap in a single day. So if you remember the pandemic, we had what we talked about, pull-through. We had a lot of pull-through, especially in semiconductors, where there was a shortage, there were supply chain disruptions. And so customers would stockpile, and that impacted things like earnings because you have pull through on the earnings, and then you're going to have the next earnings report is going to be down because they already bought all the inventory. This is the same kind of deal that's happening here. When you have export restrictions, those have a specific date that they go into action. So before that date, Chinese customers were essentially stockpiling the less advanced machines to get ahead of these restrictions. So last year, ASML sourced 29% of its sales from China, and the expectation now is 20%. So that makes a lot of sense. 9-10% pull through of customers wanting to stockpile. Here's a great infographic that shows you what that looks like. So in a nutshell, the company's down from weaker than expected Q3 bookings and outlook forecast for 2025. A lumpy revenue profile and concerns about order trajectory. And of course, that impacted other names like Applied Materials, KLA, Lam Research, and more. And we could go really deep on this topic of lithography, but I wanted to make sure that you you at least had this. You can pause this screen and read through it. But this is important when you're thinking about competition and barriers to entry. Microchips are made by building up layers of interconnected patterns on a silicon wafer. So step 3 here, lithography, this is going to be where ASML lives. ASML is definitely the leader in this space, especially when you think of advanced chips. And you hear the word monopoly all the time when you think of ASML. And also moat, monopoly and moat, right? Now, one thing to be aware of. Number one, which we've talked about in Discord. If you're not in our Discord, I got a free trial. Check out the comment, the pinned comment. Check it out. 7-day free trial to Elite. Go join our Discord. Canon, known for its cameras, launches ASML Challenge with machines to make the most advanced chips. Now, according to this report, which was back at the end of October, Canon's going to be able to do both 5 and 2 nanometer process. Now, that is significant, and there are other areas within ASML where you're seeing competition from names like Applied Materials. On top of that, China, of course, they see this as a big problem, not being able to get this equipment, so they're starting to develop their own lithography machines for domestic chip making. Now, the thing to point out here, though, is this is way, way behind. So the best Chinese tool currently, we're talking about 90 nanometers, all right, 90 nanometers. Significantly behind ASML and Nikon, but it is something to at least be aware of and keep an eye on because China could make advancements in this area over time. Let's take a look at some fundamentals, some quantitative analysis here on Seeking Alpha. Profitability grade A+, really strong growth, pretty decent growth. Of course, we got to look at that forward growth that we talked about earlier. Now, valuation-wise, this is where it gets tricky, and I think it was a bit ahead of itself when it was over $1,100 a share. This is showing about a 36. This is a forward gap PE ratio, but price to sales, you're looking at a TTM 10.5 and a forward price to sales of 9.52. So PE ratio here, this is a TTM 36.33. This does pay a dividend. It's less than 1% at 0.97%. Now, this is also going to have a foreign tax. So if you're a US resident, be aware of that. You will get charged a foreign tax on that dividend. So where should you buy? Where am I buying this stock? Well, this was a Discord buy, DCA, under $600. Most of us were buying this stock when it was in this $500 and $600 range. I said not to chase it, especially when it was up here, the $900 a share, 1,000 plus. Chart day, we do chart day every single Wednesday, Patreon Discord. We talked about being at R3 when it was up here over $1,000. We were buying the 600s, not where I'd want to buy personally. You don't want to chase. When you're above the moving averages, above trend lines, you don't want to buy those levels. This thing was down here at $363 just October 2022, and it ripped from $363 all the way to $1,110. And so now we're sitting at it, it's down here, getting close to this S3, $677 a share right now. This S3 is $661.60. Now, this previous low from a year ago, October 2023, it was $573. Now, just recently, Elastic had a sell-off like this, and we talked about in Discord, don't be surprised if it comes and retests. A lot of these names essentially had AI, and a lot of these names had AI hype train behind it, and they were really pumped higher than they should have been. And so a lot of times what the market will do is it'll erase those gains. Now, I'm not saying it has to happen, but I think there is a chance that you see it come down to at least this S3 and maybe even retest those October prices in that $575 range, something like that. It could bottom anytime, but this is a very aggressive sell-off. This is a very ugly candle, and usually it doesn't just snap back overnight. It might look like there's some buyers coming in. It's going to have some consolidation period. Lots of buyers and sellers are going to be fighting bears versus bulls, and there's a decent chance this drops in this yellow circle here. So where am I buying the stock? I think it's attractive here, but I personally have a limit order in lower. Now, the shares that I own are green. It is a smaller position in the portfolio. I own this in my primary portfolio. It's $2.3 million plus. I have a limit order in just under 660. So $659.97. I'm going to add a few more shares. If it drops lower, I'll go heavier on it. But I do think this is a great long-term investment if you're thinking 5 or more years. DCA, dollar cost average. Now, I like to have diversification in my portfolios, and one area that I'm really light on is healthcare. One of the simplest companies, highest quality companies that I've owned for many years that give me some exposure into healthcare is going to be ticker UNH, UnitedHealth Group. Now, UnitedHealth did post earnings here, and it was a beat on top and bottom lines. We did have a sell-off about 10% yesterday. We're having a little bit of a snapback today. It's up about 2.73%. But you can see here the non-GAAP EPS, $7.15, beat by 12 cents. Revenue, a little over $100 billion, 100.8 billion. That's up 9.1% year over year. This is not a growth stock. It's more of a DGIF type company. That beat by $1.52 billion. The reason it sold off, headline, UnitedHealth dips as cost concerns weigh on insurance units. So you're seeing an increase in medical costs during the quarter. Its medical care ratio for Q3 2024, it reached 85.2% compared to 82.3%. The reality is this stock ripped like a lot of them and it just gave some of that back. Profitability, A+. This has got a rock solid balance sheet. It's not going to give you a ton of growth, but it is solid for what you get. The TTM here in Google is a 37.88, dividend 1.47%. So this is not necessarily a cheap stock. It is a high quality company. And that forward PE ratio here in Seeking Alpha is showing about a 20, so much more reasonable. And you can tell usually by short interest. It has less than 1% short interest, 0.85% short interest. You usually only see that with the highest quality names. The 52-week high on this was 608, the 52-week low 436. We're going to look at a chart here in a second. Now, I came up with the idea for this video last night, and I was thinking the stock might dip a little bit more today, and now it's up 3%. So we're going to look at a chart. I'll show you the levels that I think are most attractive for UNH. Most of the buys in our Discord community were in that $450 or less price range. Some people are even adding recently here under $500. You can see it got, back in April, it got down to $436. And then this summer we had the sell off, it was around $475 a share. Now it ripped from $475 all the way up to $607, was ahead of itself. And you can see it's come down. It really came down to this S3, just below the S3. And this red line here is the 100-day simple moving average. This is the 200-day moving average, this purple line. That's about 525. Now I definitely prefer this stock lower, of course. I've owned this stock for around a decade, but if it does dip a little bit lower, I think if it comes in that 550 or less range, it could be an opportunity for the right portfolio. This is a dividend paying stock. It might not be for everybody, but it does give you some diversification, something to keep on your radar. All right, for the third stock, we're actually going to have two stocks here. We're going to enter the danger zone, but in case you don't want to enter the danger zone, I do have a safer, higher quality dividend paying stock as well. Now, this is a small cap semiconductor equipment company, and even though it is profitable, it does have significant exposure to China. I consider this a spec stock, especially because it's a smaller cap. Many people would disagree and they'd have it in growth, and that's totally fine. It's all in the eye of the beholder. This company has been around since 1978. It's Axcelis. The ticker is ACLS. If you don't understand what an ion implanter is, you probably have never researched ACLS before. It's the process of delivering materials into semiconductors to locally change its properties. Why do you do it? Ultimately, it's going to modify the characteristics to help determine device performance. And you do it by precisely delivering ions of high purity at the right dose, energy, and angle. And this is exactly what Axcelis does. So these are the fundamental steps in semiconductor production. We're dealing with equipment. We already talked about ASML and lithography. Now we're talking about Axcelis ion implantation. When you think of this company, you should think of AI and electrification. So we're talking about clean energy. We're talking about EVs, electric vehicles, autonomous driving. This is a great snapshot of what Axcelis is focused on. Their target revenue for 2027 is $1.6 billion. Now earlier we talked about ASML. That's a $285 billion market cap. ACLS, on the other hand, is now $3.15 billion. Now we invested in this when it was less than $1 billion and we made a ton of money on this. I still own some shares, but it is house shares. We bought this stock when it was something around $25 back in 2021. And the stock got all the way up to $159. We were selling in that 150 range, did very well with this stock in a short amount of time. In the past 5 years, you can see the stock is up 427%. Now in the past year, it's down 41%. And China is one of the biggest reasons why. It was also one of those stocks that just got a lot of trading momentum, a lot of AI hype, and it went higher than it should have gone. The profitability metrics are strong, B+. The growth has slowed down, and this is part of the issue, is that when is that growth going to accelerate again? If you're investing in a company like Axcelis, you're thinking about 5 and 10-year time horizons, and this growth is going to be larger with time as the industry recovers. Now, valuation-wise, this is only a 16:4 gap PE ratio. So you're like, what are you talking about, Eric? You said earlier it's a spec stock, and it's got a 16 PE ratio. It, again, deals with the market cap and the exposure to China. Now, with that said, part of the reason this stock has sold off so hard and it's below $100 is because it's kind of baked in already. Not saying the stock can't go lower, but I do think it's attractive under $100. Let's look at a chart. So in Discord, we were buying this stock way back in the beginning of 2021 in that $25 to $35 range. Now, earlier I said $160. It actually got to $201. So you're talking about ripping here from 30 bucks a share to $200 a share. Huge run in a short amount of time. Now, when people are asking me when this stock was 150, 160, I'm like, I would not chase this. This thing is absolutely ripped the last couple years. I wouldn't touch it unless it goes back below $100. Now, it's done that a couple of times. You can see $93 here in April, ripped to $158, $98, $95. Could it go lower? Sure. The S3 on here is 89 bucks a share. And if it wanted to give back all those gains going back to October of 2022, I mean, it could come down to something like 55, 60 bucks a share. But following the trend line, just looking at a chart, looking at the movement on this, unless something catastrophic happens, this stock is probably going to be an opportunity. You know, the lower the better, but in the 80s and 90s, if I'm thinking longer term, I think this is a good opportunity, but it does carry risk. That's why I tell you to consider it spec. You don't want to buy at $200 a share. You want to buy it when it's come back. This is going all the way back to January of 2023 prices. Now, one of my favorite semiconductor equipment companies that I've owned for many years is going to be ticker LRCX. This is Lam Research. Now, a lot of these charts look similar, you know, ripped from $30 back. This was October of 2022, from 30 bucks to 113. It's kind of fallen off a cliff. So you can see it's well below the moving averages. It could certainly go lower looking at the pivot points, the Fibonacci pivot points. This S3 is 65.21. The R3 is closer to $95. You're really sitting on this S1 support around $74 a share. I think this is attractive, $75 or less DCA. It certainly could go to 65 or even lower. But if you're looking for stocks to buy at prices today and lower, this is one that fits that category. This is going to be a higher quality name, does pay a dividend, you know, A+ profitability. It pays you about a 1.2% dividend. This is a DGIF stock. It does have a 4P ratio of about 21. If you're new here, make sure you subscribe to the channel and click that bell for notifications. If this video is helpful, do me a favor, return the favor, drop a like, drop a comment. Have a great rest of your day. Take care.